Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 325 on June the 1st, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Iris Energy, CleanSpark Inc, and Chewy Inc. And we discussed three new trades on Plug Power Inc, the Silver Trust ETF, and Roblox Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets finished lower on the last day of the month. The Dow Jones Industrial Average lost 383 points, closing at 38,686 points. The S&P 500 index lost 27 points this week, ending the week at 5,277 points. Now it's time for the topic of the week. And the topic of the week is theoretical pricing. Now, someone asked me recently if knowing the Black-Scholes model makes you a better trader. The model is fundamental to pricing options and understanding the theoretical value of an option. I don't want to downplay its significance at all. Still, just knowing it and understanding it will not make you a better retail trader. If you are pricing derivatives as a market maker for an institution or an investment bank, then understanding the positives and negatives of the pricing model is very important. Most professional market makers are using computer programs nowadays to price options, so the likelihood of a mispricing is extremely low. So if you're a retail trader, which most of my listeners are, you're going to be a price taker and not a market maker. A market maker creates the bid-ask spread for each option. A market taker pays the bid-ask spread for each option. So as a market maker, I always tried to buy on my bid and sell my ask price because my job was to capture the difference between those prices and the theoretical value of that option. Then I would hedge with the underlying stock or futures contract to lock in that value theoretically. As a retail trader, as a price taker, I typically am selling the bid and I need to have an idea of market direction or spread values, but I don't need to price each individual theoretical option. As a retail trader, I'm trading direction, not volatility. And if you don't know the difference, you're also most likely not trading volatility. It doesn't mean that volatility doesn't play a role in your portfolio. It does mean that capturing theoretical differences in volatility is not the main goal for making money in your portfolio. And people sometimes ask me to recommend books to help them learn to trade options. The problem is that most of the books are written for professionals who intend to trade volatility rather than trading price direction. So if you do not intend to sell stock with every call purchase or buy stock with every put purchase, you're not trading volatility. The books assume you're a professional volatility trader. And that's why so many people read the option books, and there are dozens of option books out there. They read those books and are left with more questions than answers. Imagine trying to learn calculus or physics without a teacher, only using the textbook. The teacher is there to help make sure the students learn the lesson and have someone answer questions when they need help. I'm able to simplify option trading on this show, and I'm also able to simplify it when teaching others how to trade options. And to that end, I've helped lots of people improve their performance on trading options. Many of the returns on trades have been significantly larger than the percentages we even talk about here on the show. The beauty of that is that it's all just math. Sometimes the math works out extraordinarily, and I love that because I high-five my students. I'd love to teach you individually how to look for trades where that might be possible. Now, I had several people sign up for the summer coaching bundle over the past week. I mentioned it last week with the Memorial Day holiday weekend here in the U.S. Now, we still have a few spots available in the summer cohort. You'll get immediate access to the online videos that will teach you all of the strategies that I use for trading options. Anyone who signs up will also get immediate access to the advanced technical analysis course that was recorded a few weeks ago. What I love about that technical analysis video is that I don't just teach theory. I show you how I put it all together for finding trends in the market before I start looking for option trading, option strategies that I can profit on those trends. So this group will also get weekly group coaching so that they can ask their questions directly to me and learn from each other. Someone sent me an email and asked if I was going to be using AI or if it would actually be me. Was it going to be a chatbot? Fortunately / unfortunately, it's me. You're going to hear my voice, the same voice that you hear on this podcast, and you'll see me because we'll be doing it on Zoom. You'll be asking questions directly to me, and I'll be able to help you individually as you need. Now, I'm also going to connect all the students via a Discord channel so that they can help each other out and have additional access to me as needed. So it's a 3-month program, and they're paying a small amount each month rather than a large price up front. And I know several of you have had questions about that as well. So if all of this appeals to you, you still have a few more days to sign up before we officially close the doors on our summer coaching offer, because I do want this group to be sort of to go through the process and learn together. So I'm not going to be adding people in a week or two. If you want to sign up, do so now. Take a look at it. Feel free to email me. You can ask any questions you have. You can visit the website for it, which is theweeklyoption.com/Memorial Day, or simply send an email to eric@theweeklyoption.com. So that's it for the topic of the week and my last offer for the summer coaching program. Let's get into the review of last week's trades. So we started off with the covered call. I looked at Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. At the time, the stock was trading for $7.83 per share. I looked at buying stock and selling that June 8 call at 70 cents, hoping for a return of 11.11% in 4 weeks. Well, shares of Iris Energy lost 4 cents, ending the week at $7.79 per share. The call option that we sold grew roughly 5 cents, leaving us with a net loss on the week of 9 cents. If we were to close the trade out immediately. And that's mostly just because crossing the bid-ask spread. Honestly, this trade didn't move much at all over the week. The share price is still well above the break-even price, so my outlook on this trade has not changed at all. No adjustments are needed so far, but we'll definitely need to keep track of the stock over the next 3 weeks until expiration, just in case we need to make an adjustment, or you never know, it might make a big move up and we might decide to close the trade out early. All depends. Next up, we had the credit spread on CleanSpark Inc. Symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. At the time, the stock was trading for $17.63 per share. I looked at selling the June 17.5/17 put spread at 20 cents, which could give us a maximum possible loss of 30 cents per spread. Now, shares of CleanSpark fell $1.54, ending the week at $16.09 per share. That out-of-the-money put spread that we sold is now deep in the money, or it's not too deep, but it is in the money. And this means we lost money on the spread. We're losing money so far on this trade. So we could lose a maximum of 30 cents on this spread. And it's important to keep that in mind as we start considering adjustments. Now, the bid-ask spreads are so large over the weekend, and I try to use weekend pricing so you guys can track it. But the bid-ask spreads are so large that it's really tough to get a good handle on where the opportunities are moving forward as far as adjustments. I would likely look to sell a higher strike call spread, or you could look to turn the credit spread into a debit spread. Now, we have 3 weeks to adjust this trade, so I'll have to wait until Monday for tighter markets and to get a better sense of what my options are for making an adjustment. Either way, we're below the break-even point on this trade, so we'll need to figure out an adjustment to limit the 30 cents of loss that we could incur if this spread does finish in the money. Now, be careful not to incur more cost in adjusting the trade and then opening yourself up to more risk than the 30 cents. So that's why I'm repeating, the most you could actually lose is 30 cents on this trade. So make sure any adjustment is going to limit that loss, make that possible loss less than 30 cents. Sometimes you could make a move where you're putting out another dollar in the trade, but now you might actually lose 60 cents instead of the 30 cents. Don't chop yourself up. We used to call that chopping ourselves up. Like when I traded volatility on the floor, you were oftentimes having to buy and sell stock as the price moved in order to protect your option position. And at the end of the day, you make money on your option position, but you chopped yourself up trading the stock because you bought and you sold, and you bought and you sold, and you were buying high and you were selling low to offset and try and hedge, and you just end up creating a complete mess. I really don't want you guys to do that as you're making adjustments. So the best move is to make sure that on the front end, when you're putting a trade on, don't take on a larger amount of spreads. Like, you don't have to just do one spread. I trade more than one spread when I'm doing these trades, but I still want to make sure that I size the trade relative to the maximum possible loss, so that I'm always I'm never losing more than I could afford to lose. If you don't have any more capital, you're not going to be able to continue trading, which also costs you learning, right? It's not just about making money. It's about doing the reps and actually continuing to get better at your craft. So you always want to make sure that you size your trades at a point where you can afford the loss if it does lose, right? We create trades that are high probability, that look like they're going to give us a high likelihood of return, and then life happens, right? The markets move, prices change, and we go from there. So let's wrap up that one. We'll go ahead and move on to our debit spread, which was on Chewy Inc. Symbol C as in Charlie, H as in Hotel, W as in Whiskey, Y as in Yankee. At the time, the stock was trading for $16.60 per share. I looked at buying the June 16 half call spread for 27 cents. That could give me a maximum gain of 23 cents, or that's an 85.19% return in 4 weeks. Well, shares of Chewy popped $4.62 higher, ending the week at $21.22 per share. The in-the-money call spread that we bought is now deep in the money. With the share price this high, the spread looks likely, highly likely, in fact, to finish in the money, which would allow us to keep the 23 cents of profit that we hoped for at the start of the trade. Now, no adjustments are needed since this trade is working out. You can obviously make some adjustments on the trade. In the past, I've talked about extending or widening the trade. So we started with the 50-cent trade. Let's say you were able to buy the 16 half, 18 half call spread, which would still be deep in the money. If you're able to buy that for less than $2, let's say you were able to buy that for $1.50. Well, now you've added 50 cents to your 23 cents maximum gain on the spread. So I'm not saying that was a real price, but you'd have to go in, check it out. Remember, this all comes down to math, and it's simple math. It's not even like calculus or anything like that. It's simple math. If the math works out, take the trade, right? If it doesn't work out, walk away from the trade, because it starts and ends in math. If the math doesn't add up, you're not going to make any money. So that's what I love about option trading. It's always been simple math when it gets down to just dealing with the options themselves. And if you understand the math, if you understand the options, then you can find opportunities that might give you an outsized return. So that's it for the review of last week's trades. As you guys know, we are still using the June 21st expiration date for options, the monthly options that will expire in June. That means they have 3 weeks. We are 3 weeks away from expiration. So let's get into the new trades. So our first one is going to be a covered call on Plug Power Inc. Symbol P as in Papa, L as in Lima, U as in Uniform, G as in Golf. The stock ended the week at $3.33 per share. I'm looking at buying stock and selling the June 3.5 call at 20 cents, which could also give us an 11.11% return in 3 weeks. Now, you enter this trade by buying stock for $3.33 per share and selling the June 3.5 call at 20 cents. This trade makes the most money if stock prices finish above $3.50 per share. The break-even price on this trade is $3.13 per share, and in real terms, the stock purchase will require $333, and you'll collect $20 for selling the option. Next up, we have a credit spread on the Silver Trust ETF, symbol S as in Sierra, L as in Lima, V as in Victor. The stock ended the week at $27.76 per share. I'm looking at selling the June 27 put spread at 20 cents, which could give us the maximum possible loss of 30 cents per spread. You enter this trade by selling the June 27 half put at 68 cents and concurrently buying the June 27 put for 48 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $27.50 per share. The break-even price on this trade is $27.30, and in real terms, you'll collect $20 per spread that you sell and have $30 at risk. And our final trade on the week is a debit spread on Roblox Corporation, symbol R as in Romeo, B as in Bravo, L as in Lima, X as in X-ray. The stock ended the week at $33.62 per share. I'm looking at buying the June 33 half call spread for 31 cents, which could give us a maximum gain of 19 cents, or that's a 61.29% return in 3 weeks. Now you enter this trade by buying the June 33 call for $1.58 and concurrently selling the June 33 half call at $1.27. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $33.50 per share. The break-even price on this trade is $33.31 per share. In real terms, you'll pay $31 to enter the spread, and your maximum gain is $19 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for the emails I've received over the last week. The questions are fun to answer. Had some folks ask about specific option trades, which always gives me a smile because it lets me know that you're learning, right? If you're not asking questions, you're probably not learning. So I appreciate the questions. I enjoy that you guys listen and follow along. I hope you have an amazing weekend. I am super excited that summer is here. Look, sunshine makes me smile. My mood is 100% affected by the weather. So hopefully the sun keeps on shining so I can keep on shining myself. So hope you're having a great weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.